Understanding Investments a Few Minutes at a Time by Daniel Dower from Chapter 6, Value Investing, Issue Number 21. Ships will sail around the world, but the Flat Earth Society will flourish. Warren Buffett. Warren Buffett expresses the takeaways of value investing eloquently in Super Investors of Graham and Doddsville. I can only tell you that the secret has been out for 50 years, ever since Benjamin Graham and David Dodd wrote Security Analysis. Yet I've seen no trend towards value investing in the 35 years I've practiced it. There seems to be some perverse human characteristic that likes to make easy things difficult. There will continue to be wide discrepancies between price and value in the marketplace, and those who read Graham and Dodd will continue to prosper. Intrinsic value. Distinguishing intrinsic value from price is the core of value investing, the paradigm founded by Graham and Dodd. In 1934 they wrote Security Analysis, a book so renowned for its wisdom that when the Chartered Financial Analyst Institute began certifying investment professionals, it became the primary text. In 1949 The Intelligent Investor repeated much of the same lessons, but in a simpler format for the non-professional investor. Warren Buffett calls The Intelligent Investor, quote, by far the best book on investing ever written, close quote. Graham takes great care to define terms to illustrate different concepts: speculation versus investment, enterprising investors versus defensive investors, value versus price. In Graham's words, quote, before attempting such a venture, managing a portfolio, the investor should feel sure of himself and of his advisors, particularly whether they have a clear concept of the differences between investment and speculation, and between market price and underlying value, intrinsic value. Close quote. Do you and your advisor understand those differences? How does that impact the decisions in your portfolio? Intrinsic value refers to the value of a company without reference to its market value. Numerous methods of fundamental analysis exist, but most generally involve estimating the future cash flows of a company and discounting them back to the present value. In the strictest sense, such analysis would be based on holding the company indefinitely, as a terminal value used in the valuation model would ultimately rely on some estimate of market price, as opposed to the company's ongoing cash flow. However, few practitioners of fundamental analysis take such a dogmatic approach. Jason Zweig, financial author and journalist, cites a 1973 Forbes magazine interview in which Graham asked, quote, ask yourself, if there was no market for these shares, would I be willing to have an investment in this company on these terms? Close quote. In reality, it's difficult to maintain such a discipline, but the benefit of the practice is invaluable. If, and only if, one is prepared to hold an investment indefinitely, then they may escape the chaotic behavior of market forces. An enterprising investor can choose specifically under what circumstances to sell his shares, or purchase more, but it requires an extreme level of patience and discipline not to be drawn into the public frenzies that characterize bull and bear markets. In 1996, Warren Buffett euphemistically gave us Aesop's inefficient Bush theory, in which he claimed that everything we need to know about value investments was known to the ancient Greeks. By answering only 3 questions, we can determine the value of anything. Sometimes the value we estimate may be lower than the current price. Other times it may be higher. Often we find we don't have the information or ability to estimate the Bush's value. In those cases, we should walk away from the investment. Never should we determine its value based on what someone else paid for it. Aesop's inefficient Bush theory. 1. How certain are you that there are indeed birds in the bush? 2. When will they emerge and how many will there be? 3. What is the risk-free interest rate?